Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Don't skip this podcast because the current environment we're in is very much like what we saw in the last couple of recessions. This chart does not lie, guys. So you need to really watch what we're going to show you here. It's going to give you a great roadmap for the next year or so. So let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, how's it going? As much as this market has gone up and we're seeing a lot of people, like from what we hear from other people, like the FOMO's kicking in as far as like, they think this is a dip to buy, right? The pull back from the highs and this market is rocketing higher. But if you look at like really what drives this market, and the bond market doesn't lie, right? It's really telling us quite the opposite.
Yeah, I kind of have to laugh because now they're using the analogy of, well, just like coming out of 1981, 82, we have the new bull market is forming. Well, they forget one little thing, and it kind of dovetails to our chart here, is that you have the most lopsided inverted yield curve ever.
Yeah,
and when that releases, Phil, it releases you into a very, very sharp recession. And you know why I know that? Because I graduated from college in 1982, and the job market was bleak at that time. And so, this notion that we could have the pleasure without the pain of a recession is just myopic at best. And the math doesn't lie to us. Every single time the yield curve inverts like this, there's always a recession upon the release. And I know you're going to show a chart to show a forecast for that, but I kind of want to get your feeling on it. Look, we're going to, my view, Phil, is that Powell's probably going to raise again in July. And I think that's going to set the low for the inversion of the yield curve. And then I think things are going to start breaking all over. You notice this week, tech is already breaking. Yeah. I've been shorting on and off this SMCI that they did this rip on. And look at NVIDIA was down $20 at one point today. So, we have a situation where that the high flyers are starting to get eviscerated, even though the indexes are looking okay-ish, but when the technology rolls over, it drags everything with it, and technology is rolling over right now.
Yeah, and I think things like vehicles to short those names, such as NVDS and things like that, I think are good opportunities here, risk-reward wise. But to your point, as far as the overall picture here, the reason why the yield curve inverts is because people don't want to be stuck in long-term bonds. They want to be a little more flexible. So they kind of rush to the front end of the curve. So this is a difference between what the 2-year yields and a 10-year yields. In a normal functioning environment, the 10-year should always yield more because they're going to reward you more for the longer term bond, right? You're tying up your money for a longer period of time. So they're going to reward you for that versus the shorter end of the yield curve. So whenever you get a yield curve that's inverted, it's a big eyebrow raiser. So the fact that this market kind of is in la-la land and you're having the deepest yield curve inversion since 1981, which was not a mild recession, is very telling. And I think the easy trade here, Bob, is you just generally are going to be short. And over time, this thing's going to start to roll over. And I think it's one of those situations where it's going to be like a long kiss goodbye type of top. Even you could even argue that with this market being that, it looked like we were really breaking down, then it comes back up and you're back over 4,200. And it's like, well, the market's not really suffering, right? But in reality, what we're doing is we're putting in a major lower top here going forward.
Yeah. And look, there's some trades here, guys. So I'm in NVDS, which is the 1.25 leverage short of NVIDIA. I just tucked it away into my long-term account because NVIDIA is going to Eiffel Tower down. There's another one out there called FANGD, FNGD, that looks at the top 10 stocks out there and it shorts that. There's SARK, which is basically a one-for-one inversion of Cathie Wood's holdings. So there are some stocks out there, ETFs out there, and ETNs out there that are nice to have for trading without too much leverage, which we didn't have in 2008, by the way. You always had to take these leverage vehicles, which to your point, Phil, will mean that it may be less violent on the way down. It just might be just grind you to tears. And that's my expectation, is that you're going to get these little pop days and then grind you down. Oh, I'm going to dip by, pop day, grind you down. And people aren't going to be fast enough. Like, look today, right? The market kind of popped. SMCI, I'll just give people an example. This is the third time it's done this. It popped 16 points. You short those pops and it dropped and went negative for the day. And it's done it now. Last 2 weeks, it's done it twice the same magnitude. And NVIDIA is following it, down like that too. So there are just definitely going to be some air being let out of the tires of the big boys, but that affects the indexes. So the indexes, you basically have a slow leak. Phil, I want you explain this next chart. We have a predictive forecast here based on when the inversion has hit its bottom. And if you want to kind of show people what we're talking about, this is 3 times now over the last 40 years.
Right. So to your point about the market kind of going down and popping higher and going down, popping higher, that was very much like the dot-com. If you look at the daily chart of the top of the dot-com market as it rolled over, it kept giving everyone this ray of hope every time because it would rip up, and we're seeing that similar price action intraday. You see that where you get these little quick V reversals, right? And it looks like, oh, here we go. We're getting into like what we saw for most of June, and then it just stops and comes back down. So it's very difficult, especially when you see that on a daily time frame. It's very difficult to get too bearish, but at the same time, it's just a bunch of lower highs and lower lows. But to this chart, what we're looking at here, let's go back to the left here. You see yield curve inversion. So when the yield curve gets inverted, that's when this line turns red. So the upper part of this chart is the 2 and 10 yield curve. Normally it should be positive. In times of stress in the market, in times of recession, you get the inversion. So when the yield curve inversion starts to bottom and makes its way higher, and you think, oh, well, that's good. We're all in the clear. Well, it's not good, because the process of the yield curve normalizing back to what I would consider a normal level of 2.3% positive, not negative, that's a very bearish time in the market, because the bond market basically was bracing for this, and then now it's starting to normalize. But the bond market typically will yield, that the yield curve inversion will lead the actual economy. Okay. So in all of these examples, you see where we go through a long period, a prolonged bear market, and you'll notice I think the setup here is more similar to the dot-com era, where, we've got this AI narrative and things like that, but that's not the only reason why. I think we're in for a more prolonged drop, more so because of the Fed is intent on getting the excess liquidity out of the system. For those of you that have the Fed liquidity chart, if you zoom out on the weekly time frame, you'll see that we got a lot of air to let out of this excess air, right? Because it's overinflated, and that's why we're seeing persistent inflation numbers. And maybe in tomorrow's video, we'll show you what the economists are now looking at, and they're forecasting persistent core inflation now. So the Fed has no reason to let off the gas. But you'll see in the great financial crisis, the yield curve was basically signaling that there was problems, and of course we roll over, then the yield curve inverts, and you're basically under pressure until that yield curve gets back up to that 2.3%. So in both of these last examples, that was over 100 weeks, and that's going to take us out to the end, or basically the Q4, Bob, of 2025, and that's what this looks like. If we are to play out like we normally see, we're looking at, and I know you've been saying like worst case scenario 2,900, and it's funny because this kind of plays into that. And it's, again, it's not like a crash. It's more like you're now, everybody after a while looks around and goes, man, this market ain't going back up. It's a bear market, right? And then you have one final typical waterfall. When we get this move and it feels like the world's ending, that's when you really should be loading up the truck. And also, too, you'd be watching for gold and Bitcoin to actually start leading the market higher in this area. And that's, you're probably within a quarter of the bear market being over. But my goodness, the gains you're going to get from this area, because make no mistake, right? The economy is going to continue to grow. Tech's going to continue to grow. We're going to be making advancements, and there's a bright future ahead of us, I think, into the end of the decade. But you can't ignore the fact that we're dealing with this inversion that we have here. Right. It's just, I think it's if you think this is just going to continue to go higher with the yield curve as inverted as it is, you're just not being realistic.
Look, we've had massive malinvestment, and Jerome Powell is determined to now not allow future liquidity to flow into real estate, and he wants it to flow into more productive assets in the past. So right now, everybody has so much money. I was joking with the guys before we got on, is that I have friends now are just like itching to buy real estate again. And I'm like, why are you in such a hurry to lose all your money? So we have malinvestment, we have demographic issues, we have people that can't afford the, to rent, not nonetheless buy a house, and we have people kind of rolling off the world right now. So there's going to be excess housing stock that people can't afford. And if we're right on food and energy going back up, it's just going to squeeze people out of these investments. So all this stuff has to get wrung out. And remember, this AI investment that's going to happen, it's going to be a unemployment maker, because companies, as the economy slows down, they're going to look at every single way in which to replace a person with this machine learning, artificial intelligence type of scenario. And so I think people aren't understanding this. And I think Powell wants to wring out this whole COVID nonsense. And that brings us down into the mid 2000s. I could certainly accept 2,900.
I could too. And I don't think this scenario is on anyone's radar, because the market's never really behaved like this since over a decade ago, right? And a lot of market participants that have gotten into this market recently that were, probably younger, weren't of the investment age group, just have not gone through this. So it's going to be interesting because we do have a different market now. It reacts much quicker, but I just think that there's a whole league of investors right now in this market that have only seen up, and they're now going to go into a different season they're not used to. So, and it's not going to be just all down, right? I mean, I think this was a good example from the beginning of the year of how markets can go up, even though the underlying technicals are forecasting lower, right? And you're going to get periods of these V reversals. So it's not all doom and gloom, but you are going to be overall, if you just got hedged short, it's going to be long-term alpha for you, because ultimately you're going to be, if you're not interested in these shorter term, swing trades, and you're just more concerned about, timing the overall cycle down. So we have the top right here, and ultimately we're going to get a low down here. If that's all you're concerned with, then this is kind of the lazy trade. You're just going to be rolling out options, or you're going to be in leaps, or you're just going to be in futures, and you're rolling them quarterly, right? People like futures because if you're shorting like the SPY, which is the ETF for the S&P 500, that short has a little bit of interest, which is elevated because the interest rates are way up. But if you're shorting futures, there's no interest carry. In fact, if you're short, you actually have a little bit of a tailwind, because the premium shrinks toward par, or shrinks toward the spot price of the S&P 500. Right now it's at a 40-point premium. So as the market goes down, you're actually going to gain an extra 40 points. So people sometimes don't understand that. So futures, mini futures, micros, they're actually a favorable way to do this, and you keep rolling them out every quarter. I think is least expensive, let's say, but does require more capital. So if you're conscious of that, out of the money puts, but you got to go out a ways, actually can give you more bang for your buck, but you got to be good on timing and things like that. If you don't want to worry about timing, then you can do micro futures and just hang out in those. That's an example of taking advantage of this. The other things you could do is just buy leveraged ETFs. Those do have a decay too. If you're buying like an inverse ETF, you have to be cognizant of that. So if the market's going sideways for a couple months, that can eat into your P&L a bit as well. So those are just some ideas. If you're interested, you can get into the rooms and stuff with us. We also have like courses like the bear market course that'll tell you exactly the technicals to watch for when we get to the bottom of these types of markets. So check out our stuff over at tradegenius.co. But other than that, Bob, I just wanted to show this chart, and I think it's very obvious. I thought it was timely to come back to it, because I do think on the bigger picture, things are rolling over here. And like you and I have been holding to, we're now in this going into the second half of the year, which technically starts July 1st. And I know you and I both have been, pretty adamant that that's going to be the second half of the year is going to be a lot of headwinds for this market.
Yep, and risk off signaled on Friday. So now
Right.
We're looking at opportunities to short. And just remember, everybody, they trained this market on zero DTE, but there's zero DTE puts. problems too.
Yeah.
So Wall Street wants you in the market. So they don't care if it blows up stock values as long as you're in there generating transactions for them.
Yep.
They don't care. They'll get people on these 0TT puts in a New York minute. This is going to be a wild ride. So buckle up and enjoy it because we're going to make a lot of money. And with that, Phil, I think I'll let you go. I think we're positioned correctly, and we're going to share a lot of stuff. Tremendous opportunities. That's all I'll say. I'll just keep repeating myself. When these markets go down like this, it gives us tremendous opportunities to start swinging because volatility picks up. Good subject today, Phil. I'll catch you tomorrow.
All right, guys. Thanks for watching. Please hit like and subscribe, and we'll catch you on tomorrow's video. Take care. Bye-bye.
Trade Genius.